Price action is not random noise, but rather the visible consequence of the hunt for stops. The movement you see is the deliberate work of the dominant market operators sweeping the board clean of weak hands. They are engineering the price to reach a point where maximum pain and maximum liquidation is guaranteed. This is the simple reality of speculation. Price moves to where the money is resting. Retail analysis, the kind you see across the internet, predicts continuation. They see a breakout and immediately jump in, demanding that the price obey their technical indicators. Smart money, however, anticipates failure at those exact points. They understand that the breakout is often nothing more than a carefully crafted magnet designed to pull in the last remnants of the late-to-the-party crowd before the inevitable reversal. The profitable speculation is always counterintuitive to the masses. The institutional footprint reveals the only supply and demand zones that truly matter. These are not the arbitrary lines drawn by an amateur. They are the price levels where enormous volume was transacted, leaving a clear and heavy indentation. When the price returns to one of these zones, it is meeting a real wall of orders, not a psychological barrier. I only acknowledge levels where the professional hand has left an unmistakable sign of heavy business. Imbalance is the primary, relentless fuel for every major directional movement. When the market moves with such speed that it leaves a gaping hole in price delivery, that inefficiency creates a structural imperative. The market cannot proceed indefinitely, leaving large blocks of untraded price. It is fundamentally unsound and must eventually be revisited. This structural debt acts as a powerful anchor and a guaranteed future target. A major run is nothing more than the market aggressively correcting an old inefficiency or creating a new one that must eventually be filled. Liquidity always, without fail, dictates the next direction. The market will move where the greatest pool of resting orders lies, regardless of the news headlines or the latest technical signal. Indicators are merely confirming history. They tell you what has already been done and give no insight into the professional's intention. The truly disciplined speculator looks for the structural weakness in the field, not the flickering light on his screen. I do not trade the indicators. I trade the pure consequence of money flow. The chart is merely a map of where the amateur money is exposed and where the professional money is accumulating. The direction is set by the need to liquidate that exposure. Price seeks inefficiency with the determination of water flowing downhill, specifically targeting the fair value gaps and the structural imbalances left behind. These are not just gaps on a chart. They are the market's memory of an incomplete transaction, a vacuum that must be resolved. Furthermore, mitigation blocks, those areas where professional money failed to hold the structure, become prime areas for price to return and complete the unfinished business. I treat these zones as high-probability turning points because they represent the market fulfilling its duty to balance the books. The price will invariably return to complete the original contract, allowing the dominant players to exit or re-enter their positions. High-volume nodes, areas where the majority of trades were executed and their surrounding value areas act as immensely powerful magnets for the price. Price is comfortable where business was transacted. It is naturally drawn back to the most agreed-upon value. When price leaves these areas, it is often in search of liquidity, but it rarely sustains a departure for long without a trip home. A major movement must be confirmed by the volume at the anchor price. I view the HVN as the true center of gravity for the market. The price might oscillate wildly around it, but it will always return to the mean established by transactional volume. The accumulation phases are characterized by a monotonous engineering of liquidity, often disguised by the creation of equal highs and equal lows. The inexperienced eye sees these tight ranges as indecision or a breakout pattern forming. The veteran knows that the professional hand is merely loading up at the lower end and allowing the herd to build sell stops above and buy stops below. This engineered trap is the necessary setup before a powerful, sustained run. Never trust the seemingly neat geometry of a tight range. This is the deliberate construction of the eventual victim's positions. Structural breaks confirm the definitive intent of the dominant market participant. This is the key signal of a changing environment, not a fleeting rumor. It is not enough for the price to merely poke above an old high. The break must be decisive on strong transactional volume, and it must hold the new structural level. When a higher high is followed by a higher low that respects the previous market structure, the intent of the buyers is undeniable. The structural break is the market's declaration of war on the opposing side. It announces that the large money has decided upon a new direction, and the previous trend is now history. Time cycles compress the volatility into predictable, often repeatable rhythms, inevitably leading to explosive expansion periods. The market's energy is not infinite, it accumulates and discharges. This compression is visible as tightening ranges, low volume, and a general lack of enthusiasm. When this energy reaches a critical saturation point, the resulting expansion is not a surprise event, but a mathematically predictable release. I track the time, not just the price, because timing is everything in speculation. The movement is merely the response to the coiled spring of market energy being finally released. The market takes its rest, and then it delivers its verdict. Unmitigated price deliveries, those hasty moves where price left behind significant imbalances in untraded levels, must be permanently acknowledged as future, high-probability targets. These structural omissions are not errors, but deliberate acts of aggression by the professional. They leave a trail of breadcrumbs. The market, in its relentless pursuit of efficiency, is obligated to return to these points, if only to sweep the remaining liquidity and clean up the unmitigated structure. I treat these zones as a binding contract. If the price delivered violently in one direction, it must eventually return to justify the initial acceleration. Consolidation below a major resistance level is often nothing more than professional distribution, silently and steadily offloading supply to the eager amateurs. They mistake the tight range for a coiled spring ready to jump higher, but the professionals are selling into the manufactured strength. Conversely, consolidation held firmly above a strong support is typically accumulation. Here the smart money is absorbing all the weak hand selling before the next leg up. The context of the structure is the only thing that gives meaning to the box. You must ask who is buying and who is selling inside the quiet range. The 80-20 rule dictates that true, sustained directional conviction only manifests after a brutal, necessary shakeout has successfully trapped the marginal players. The market needs fresh victims for its engine. It will make the breakout look spectacular, suck in the late-arriving crowd, and then viciously reverse to take their stops. This moment of maximum psychological surrender is when the true move begins. I recall a time early in my career staring at a chart that showed a magnificent push past a long-held high. I bought the perceived breakout, feeling the rush of certainty, only to watch the market reverse $50 the following day, wiping me out. The lesson was brutal. Never trust a push that doesn't first punish the majority. The clear conclusion was that the market operates to frustrate the maximum number of people possible before moving in the direction of least resistance. A true reversal of the trend requires unmistakable displacement and an unquestionable break of the high time frame structure, not merely a weak lower time frame stutter. Amateurs confuse normal profit-taking and minor pullbacks with genuine trend change. The real shift is a violent, highly energetic move that breaks the dominant swing point and maintains that new structure upon the retrace. If the market is simply wobbling, it is likely gathering energy for the continuation. You must see the structure decisively fail before you even consider entering on the opposite side. The new direction must be announced with authority, volume, and an undeniable commitment from the dominant participant. You must never, under any circumstance, enter against a defined high time frame trend until the order block holding that structure fails decisively. The order block is the final line of defense for the dominant position. It represents the last major accumulation of orders by the large operators. To trade against the trend before this structural defense is broken is simply gambling against the market's most committed player. Wait for the market to give its declaration of surrender. Wait for the order block to be invalidated. Only then does the short-term counter-trend become a viable, higher probability opportunity. This discipline protects your capital from the market's brute force. Market correlation across asset classes confirms the underlying risk sentiment bias, an indispensable tool for conviction. When the currency markets, the bond market, and the equity indices all confirm a defensive posture, your view on a single stock becomes exponentially more robust. This is the market speaking in unison. If your stock is rallying while the major indices are collapsing, you must question the structural integrity of your position. True conviction comes from seeing the entire financial ecosystem agreeing on the direction of money flow. Never trade in a vacuum. The risk sentiment of the entire global mechanism must align with your singular trade idea. The optimal trade entry, the highest probability entry zone, consistently operates around the 62% to 79% retracement of the initial move. This golden area is where the market allows the professional to rejoin the trend at a deep discount while still holding the integrity of the original move. Amateurs chase the market at 20% or 30% retracements, only to get stopped out when the market finds its true resting place. I have found that waiting for the deeper retrace, the one that makes the amateur nervous, is the hallmark of disciplined speculation. Patience to wait for the OTE means you are trading with the professional money, not against it. Extreme extension away from a significant moving average is a clear, unmistakable signal of imminent mean reversion or a violent counter-trend reaction. When the price is stretched taut, fueled by emotion and FOMO, the snapback is not a possibility, it is a certainty. The market is not a rubber band, it is gravity itself, and it will always pull the price back toward its center of balance. Trading at the moment of extreme extension is chasing a dead trade. The profits are made by the ones who stand ready to take the other side of the panic. I learned long ago that the fastest moves are often born from the panic that occurs at the point of maximum emotional extension. Contextual confirmation must always precede the execution, validating the trade idea across multiple time frames before your finger touches the button. A potential setup on the 1-hour chart is meaningless if the daily chart shows you are trading directly into a major order block or a high-volume node. You must read the market from the top down, starting with the macro structure. The high time frame dictates the trend and the key levels. The low time frame is merely the entry trigger. Never take a trade that does not harmonize with the greater structure. This layered analysis is the difference between a high probability trade and a rushed speculation. Stop reacting to the news headlines and start anticipating the engineered volatility events. The news is merely a mechanism, a carefully chosen catalyst to achieve the professional's objective, to grab liquidity. The movement happens before the news is released or immediately after, and it is designed to trap the emotional players. I do not trade the news. I trade the market's structural anticipation of the event. Trading success is not about maximizing your win rate percentage. It is solely about managing the probability of risk on every single transaction. A speculator who only wins 40% of the time but manages his risk correctly will consistently outperform the amateur with an 80% win rate and undisciplined position sizing. Your primary goal is not profit. It is the preservation of capital. You must accept that the pure, unfiltered market structure dictates the trade, and your personal opinion holds no value whatsoever. Your ego is the single most expensive habit you can have in speculation. The market is never wrong. Your interpretation is. Focus your energy on mastering one single repeatable setup that perfectly adheres to the principles of institutional price delivery and liquidity engineering. Become a specialist. The jack of all trades is usually the master of none, and he is a consistent loser. The unspoken rules of the financial markets are clear and unforgiving. They fundamentally favor the cold, disciplined student of liquidity over the emotional, reactive gambler. This is not a democracy. It is a hierarchy. The knowledge of where the money is resting is the only true advantage. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I'm talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.